The Consumer Confidence Board, the Conference Board Consumer Confidence Index is out and it is weaker than anticipated. It continues to roll over and roll over fairly aggressively. Consumer confidence certainly taking a hit, but unsurprising given what's happening with gas prices, given what's happening with mortgage rates. We come through at 98, Alix, 0.7. 98.7. Now, the prior number was 106.4, but that has now been revised down to 103.2. The survey number here was 100. Present situation's 147.1. The prior number there, 149.6. And the expectations number drops to 66.4 from 77.5. These are, and that prior number has been revised lower as well. Then you've got the Richmond Fed Manufacturing Index, which has come through at minus 19 from minus 9. The survey there was expected minus 7. These are not good data, to say the least. These are not good numbers. The consumer certainly appears to be rolling over and rolling over fairly quickly. But that's just my take. Let's actually get an expert on what is happening here with these numbers. We're joined by Dana Peterson, Conference Board's Chief Economist. Dana, they don't look good to me. How do they look to you?
Well, certainly the data are starting to weaken. The overall measure ticked down again. And it's really not that surprising. Consumers are being buffeted by higher energy prices, higher food prices, higher rent and housing prices. They're also seeing interest rates rise, which means that it's much more difficult for them to finance things like cars and cell phones and purchase homes. So it's really not that surprising that confidence is continuing to tick lower.
Can we talk about the expectations for a second? Because it looks like on the expectation level, we're down to levels we haven't seen since 2013. Can you walk me through a little bit of what we learned from the expectation read?
Sure, absolutely. What the expectations numbers are telling us that consumers are potentially seeing a recession around the corner. Any number below 80 is a recession signal for the expectations gauge. Indeed, here at the Conference Board, we have downgraded our forecast of the U.S. economy. We do expect a brief but shallow recession starting in the fourth quarter of this year and then extending into the first quarter of next year. So what consumers are telling us are consistent with what economists are now expecting.
Dana, I hear what you're saying about the fact that in some ways this is unsurprising. The consumer is certainly being buffeted by a number of factors right now. But the rate of change is what really catches my eye. Are you surprised by the rate of change? The confidence numbers are decelerating very quickly here.
Well, certainly they are. I thought they would have come down even faster, but it's been really holding up. And that's because the present situation numbers are still pretty healthy. So right now, consumers are working. They're seeing wage increases. Some of them still have savings from stimulus checks. And so the income is still coming in and they're able to weather the inflation that they're seeing. But that's certainly part of our headline. So that's keeping the number from falling dramatically. But still, that expectations gauge is worrying.
Especially the median inflation expectation now sitting at 7.7% versus 6.8% the prior month. I wonder, Dana, how sticky do these numbers tend to be in that if we wind up having commodities, say, come off the highs, right? We have financial conditions are tightening, et cetera. How fast can we actually revert to the positive?
Well, I think it's going to be some time. Certainly our own inflation expectations in terms of forecasts, we still think that you could have a big number on inflation for June. We're hoping that the second quarter will be the maximum in terms of year over year inflation rates, but still inflation is going to take some time to come down. Even by the end of next year, we have the PCE deflator at 2.6, 2.7%, which is still above the 2% target. And that is including what we're anticipating are going to be many more interest rate hikes by the Fed and even raising the Fed funds rate to the range of 3.75 to 4% by early next year.
Just worth pointing out to our audience that we are seeing a little bit of a rollover when it comes to bond yields, i.e. prices are catching a bid. Certainly you're seeing that at the 2-year level and also at the 10-year tenor over in the United States as we watch this number have an impact on the market. Dana, we've been much lower than this. During, obviously, the great financial crisis, the GFC, we were down in the 30s. How low do you think this number goes? You're talking about a mild recession. What is a mild recession commensurate with in terms of the headline numbers here, do you think?
Well, the thing is that you can't really match up the consumer confidence index against GDP. They just move very differently. So it's really a signal of confidence as opposed to forecasting GDP. But what we're thinking is, slight dips in GDP minus a couple of tenths of a percentage point in the fourth quarter, and then again minus a few tenths of a percentage point in the first quarter. So, and then some uptick in the unemployment rate, probably at around 3.7%. And that's actually material because we were thinking the unemployment rate was going to fall to 3% by the end of next year. So we're really coming from a position of strength. And so we think that, again, there will be a recession. It won't be anything close to what we saw to the pandemic or even as long as what we saw with the Great Recession.
I should point out that equity is also rolling over here. S&P still up by 0.5, but nonetheless well off the highs of the session. Dana, does the Fed look at data like this and say, I can't do all the hikes that I wanted to do? We're going to have to wind up stopping hiking or cutting earlier than we thought?
I don't think so. The Fed is looking at inflation, and there are three things around inflation the Fed's concerned about. The Fed is concerned about the actual inflation numbers. The Fed's also very concerned about expectations rising and becoming unanchored. And the Fed is very concerned about its credibility. And so I would imagine the Fed is going to continue on its track. The weakening in confidence is commensurate with what we're expecting in terms of growth and the fact that inflation is going to remain higher. I think the Fed will continue on its track.
Dana, final quick question for me. If gas prices came down significantly, say they came down $1, say we came down by that order of magnitude, 20% here, how big an impact would that have in terms of consumer confidence, do you think?
I think it certainly would help with inflation expectations because certainly 1 year inflation expectations are very much tied to gasoline prices, but they're tied to food prices. And certainly until we have a resolution to the war in Ukraine and the effects that it's having on food and energy prices, as well as on metals and semiconductors and everything that semiconductors go into, we're probably going to see these upward supply side pressures on inflation. So I think consumers, $1 off, certainly I would love that as I fill up my gas tank, but still very high inflation that consumers are going to be facing over the course of this year and potentially into next year.